and then she gave me one or a few for Christmas last year. The king. I have one that says grizzly, which is a bear, and I have one that's a Rottweiler. It says alpha on it. Then I have all my Einstein hats to promote the brand, since I own a little bit of that, and Steve, and then I have one other hat that I wear in here, which is my buddy's waste management service, and up there in Massachusetts, which is totally random, but I told him I'd wear it on here occasionally and on my podcast.
Cool.
Marketing, baby. How are we doing today, boys?
Awesome. Good to be alive.
Cold here now. Cold here today, but going to warm up later in the week. And then I'm hitting the Phoenix at the end of the week.
Good for you. I'm doing the opposite of you. As I'm here in California, and I'm going to the Bailey the Beast in the Midwest, to Wisconsin, and I'm like,
nice.
I'm just getting nervous about how cold it's going to be.
Christmas in Wisconsin.
Yeah, it's always fun, family and stuff, but I don't think the weather is like the best part of the sell. I think it's stay inside and turn the fireplace on and drink some brandy.
Amen.
Yeah, it's supposed to be warming up here. The weather models continue to turn the warmer, and that's whacking natural gas here again this morning.
Yeah, I mean, I told you when we were on the show last week, Bob, weather was that summer was over or winter was over. My buddy who trades power messages me, and he's like, "Winter's over," and I looked up and saw nat gas was down 20%, and I was like, "Yep, that's what those guys all take those NOAA 2-week forecasts, and that's the deal."
Yeah, and the news earlier this week was El Nino's in here for the full winter, and if you look at the maps that they put out, it just says it's going to be colder than normal at the very top part of the country and dry in the rest. So yeah, the forecasts for the winter are not playing in our favor right now. In our favor if you're long the gas.
It started off pretty cold though, to be fair.
Oh yeah, the last 2 days here have been very cold.
It's rock and roll, boys.
I'm gonna retweet this. Hang on.
Okay.
All right, let's rock and roll. All right, it is, what is it, the 16th? Yeah, 16th though. Only 2 weeks left in the year, boys. Welcome to Wall Street Beats. I'm Benjamin Bry, joined with Kevin Baker and Bob Morris. We are joining you Tuesday after a big data dump of catch-up data, economic data that was a little messy. Let's get it going. The one thing that's be interesting to talk about is that we have $55 oil 55 handle on oil, Bob. How we feeling there? We're gonna have that 4 handle that I was asking you about maybe a month ago.
I still don't think we're going to see a 4 handle. I mean, a lot of people have been advocating for $55 oil technically, where the traders want to take in. They've got it to 55, but the news out this morning is, we talked a little bit about earlier in the week on Russia, Ukraine, and the closer it appears that there may be a peace deal, the more that weighs on oil prices, because as you know, that would lift the sanctions on crude oil exports from Russia at the same time that the Trump administration's out there trying to seize all these ghost tankers that are shipping sanctioned oil out around the world anyway. The other data that was new this morning was a little bit weaker economic and retail data out of China. And every time you get weak data out of China, that impacts the demand picture for crude oil in particular. And that's the other factor weighing on oil prices this morning, despite exports out of Venezuela being down and what's going on with the Trump administration seizing tankers there and such. But overall, net, it's just a supply outlook and potential for a peace deal between Russia, Ukraine, and maybe weaker data out of China. That's all weighing on oil. And technically, they want to take it to 55, and they've almost got it there today. So we'll see. If you look at the energy names, a lot of these energy names that we like are still up year to date, barely. I mean, C&Q's holding on to a bit of a year-to-date gain, as is Exxon and Chevron. So, I'm sticking with those names. I don't think we see a 4 handle. That would really be, I think, reflective of something negative on the economic front, on the demand front. Everybody's been forecasting this oversupply situation in 2026 for a long time. So that's not a surprise. It's just that whether on the margin you get a little bit more supply from Russia if there's peace deal there. In the meantime, as we mentioned, and we talked about pre-show and earlier in the week, Ben, it's just everybody's looking at the weather models on natural gas. And it's amazing the turn we've seen in natural gas from $5 now down below $4 here this morning. And it's purely on all the weather models saying that, again, a demand issue. if the winter's going to warm back up and we've got El Nino and it's not going to be a colder than normal winter, if the winter's over, as your buddy said, Ben, that's not a positive for natural gas. But I'm sticking with the gas names. And, in particular, what I'm keeping an eye on is Expand and EQT. And I've got my Chesapeake hat on this morning. That's
Nice.
Expand used to be Chesapeake. Expand's the old Chesapeake, but it's a different company now. That's a name. If it gets back below 105, that's where I look to maybe pick some more up. I've got a big overweight position in it, but for those who don't own it, if it gets below 105 and bakes, you can jump in here technically as to where you think that entry point is. But I'm keeping an eye on that if it were to pull back here, because while the weather's a wild card and we can't predict that, it's still a big beneficiary of the whole AI data center build out and LNG export build out coming in 2026 and 2027. In the meantime, the only thing I'm really doing here is I'm continuing to nibble on Valero. I don't have I'm far from a full position in that, but I like the name. And, again, a name that should benefit on lower oil prices with the economy remaining strong. As Ben and I were talking about, I mean, your input raw material price is crude oil, and the output is the product gasoline, distillate, and fuel oils. And where the demand's holding up in a strong economy, that all bodes well for refining margins. So I'm continuing to nibble a little bit here at Valero to slowly build a position there.
Yeah, well, I haven't thought about refiners in a long time. Let me see that Valero chart. Bakes,
I mean, it's not
you
big
got
year to
the,
date. It's been
It's
a
right
big
there.
outperformer.
but it's
Here's the
off
daily.
recently, is what you're saying.
Here's the weekly.
You got it on there, okay.
And here's the monthly. So these can be great stocks. These can be really,
Oh
really
my
great
God!
stocks.
Oh my God! Like in
Yeah.
2000, in the beginning of the 2000s, these things were
Yep.
just absolutely wonderful stocks.
Yep.
Yeah. So Bob, you seem pretty positive given the state of play on the front of the curve in both gas and oil. Is that just a confidence of like, the worst of this supply is probably embedded in the curve now, basically, and like,
Yeah, that's a big part of it. I
expectations
don't
are
think oil can.
are pretty low.
I
So
just
the
don't
only
see.
thing they're really surprised would be like a serious. Go ahead.
Yeah, I don't see a
Go
lot of
ahead.
downside to oil. I don't see $50 handle. Now the forward curve is pretty flat. I'm looking out to September, August. We're still around 56. So you've still got a pretty flat forward curve on the crude oil. But at these prices, these companies still generate free cash flow. C&Q came out with their budget for 2026 this morning. It was pretty much in line. No surprise there. But they're going to, even at $55 oil, they're generating free cash flow. They'll pay down debt. They'll continue to buy back stock, and they'll continue their track record of probably boosting the dividend in the first or second quarter of next year. So even at these levels, these companies continue to have the best free cash flow yield. I think even at $55 oil, the best free cash flow yield of almost any sector in the market. And in my opinion, continue to look attractive from a valuation standpoint. So, to get negative on the sector, we would have to argue for a four handle on oil. I mean, and the break even, if you look at break even being what price they need to just keep things flat. For most of these companies, it's around $40 a barrel, plus or minus. So they're not in a dire strait where they have to cut back and let production decline.
Still there?
I'm frozen here. Oh, there we are.
Bob, let me ask you this: is the when you look for a oil equity that has the highest beta, like I was just pulling up CRC, California Resources, that was always one. You always had Danbury. Like, what's like the high beta play on oil within equities these days, in your opinion?
I mean,
Or is there even really one anymore?
probably Oxy. They've paid down a lot of
Yeah.
debt, but they've still got a fair amount of debt. They're very well levered name. Um, Oxy's going to be up there. Diamondback's going to be up there. CNQ's an oil levered name, but
Yeah.
Oxy's sort of the data.
Oxy's chart looks
Oxy's the,
actually.
Looks like
Yeah, I was saying, what do you think about that Oxy chart, Kevin?
Warren got this. Warren got this one wrong.
yeah,
So
and
far,
I've never,
so far, he's gotten it wrong. He's
yeah,
a
and
longer term player,
You
so
know,
so
how
so
long has he
far.
been here? 5 years.
yeah,
I think
it's
he started getting
more
involved
than
right
five.
around COVID. Yeah,
Okay.
so
All right. All right.
Since
So maybe bought it, with negative oil, that kind of thing. So good. Your timing is everything, I suppose. But I wouldn't touch this thing.
it is because I remember in September of 2020 buying the warrants on this thing for $2.25 that ended up going to like $40 or something like that.
Right.
So
Right.
that was the most levered. So whether I asked Bob what was a high beta play within the equity space to oil, that was the highest convexity thing I could find. There was a lot back then. You know,
yeah, more than today. And I've
well,
not been a big fan of Oxy. It's
negative
one of the
$47
names that's
oil at one
down year to
point
date, so it's
in
not
2020, right?
been a good name here.
You there?
Yeah,
The other dynamic of play. I mean, and you see the same things I do. Is that the there is some subtle shifting out of tech into healthcare first, and to a lesser extent energy. And
hmm
this basically just looks like it hit a wall when the energy spider XLE. Obviously it for the last week when nat gas goes from 5+ to 4, that's what's going to happen. But I was talking to Bob offline. Ben, when was the last time you saw credit default swaps on a CNBC screen?
I don't watch CNBC, so I'm not the guy to ask that. But
Okay.
as a guy who has a fund that we own credit default swaps, I'm probably looking at them much more than the average person is.
Okay.
So I don't actually know, but I hear what your point is that
The
like,
co- the, co- the
you
core weave
know,
the core weave CDS are on the screen. It seems like every 11 minutes, and
well,
I don't recall that.
I mean, I wish I had this. Maybe I can send this to Jen real quick. But the core weave thing, you look at the CDS is about 750, the 5-year CDS, and then the equity is about 70. And from September till now, they've gone the opposite way, as you'd expect, right? Credit spreads go up, equity goes down.
Yeah.
And I mean, I think it's a function of the whole credit market like repricing a lot of this stuff. I mean, Oracle CDS went from 42 basis
Same
points to
thing. Yep.
125, and now Meta actually has CDS. So if we go back a year, there wasn't really much of a credit component to this whole thing. Then, in September, I spent a couple days putting my old analyst hat on and I downloaded the models off of one of the big brokerages and I was digging in. And you could see like a Meta was running up. None of these guys have much in the form of excess free cash flow anymore. Nvidia does because all this capex is going to them. But of the hyperscalers, and then you throw in Oracle and CoreWeave with them, they were either using all their excess free cash flow or they needed to take on debt to pay for it. And so the guys that have traded the worst are the ones who have the worst credit profile. So the market's actually traded this pretty rationally, to be honest. Like Meta got re-rated down, but just equity because its debt deal is fine. Amazon's kind of in line, and they did a debt deal. Google's been up because people like the TPU thing, and they did a debt deal, but it was traded okay. And then CoreWeave and Oracle have absolutely gotten hammered because their financial position is by far the weakest. And I think the real thing of why they're probably putting this on is because I think there's anxiety right now. I read an article this morning that showed there's a huge amount of pushback against these data centers. The amount of data centers that are getting rejected across America is skyrocketing. I think we're up to like
Yeah.
37 or 38 that have been
Yeah.
rejected. I think there's a serious pushback, and I think for the next year, for the midterms, this will be one of the bigger political issues. If we have $55 oil, I do think the inflation thing's not going to be something people are talking about. I think that's yesterday's news, the inflation worries. But that can be rectified also with lower margins. But the thing that will matter is this AI and this data center thing, and people's utility bills keep going up, and so that is
Hmm.
actually one area of inflation that's really driving people insane, along with the healthcare premiums. But that is something to keep an eye on, especially for if you have a bullish thesis on Kevin's. You like the nuclear names and the uranium miners and some of these power names, and all that stuff's been re-rated very sharply down because I think there's it's just a combination of effects of like, oh, we're debt financing this. We're not sure the return on investment. There's a lot of people questioning whether OpenAI actually is going to ever be able to pay the bills on all these obligations that they kind of sent out there. And so, it's a good time actually for picking stocks because even within the Meg Seven, there's more dispersion within the Meg Seven than there's been in years, right? Like year to date, Amazon's flat, whereas Google's up 42, and Nvidia's up 30, 31, and a few of them are just single digits. Meta's like up 7, so and then if you wanted to go into the higher beta stuff, like I shorted you guys know I shorted a lot of those bubble stocks in October, but like I shorted the Oklo, for example, at 166. I think that thing's got an 8 handle on it now. So we've had some serious repricing of this entire thing going on, and now with energy prices where they are, it's definitely an interesting time to be involved in this stuff. I guess is all I'd say.
Yeah,
Yeah, and
there is
I
a lot of that NIMBY theme has come back where now people don't, like you pointed out, don't want these data centers in their backyard.
Yeah, I think the water part of it is a big part of it too. Like if you go, if anyone wants, just go to YouTube and Google like meta data center or data centers rejected or the dark side of data centers, something like along those lines for the search. And there's lots of videos like showing like what's happened in communities where the water it takes up a lot of the water. Now,
Yep.
over time, it actually should help their power bill. So I think that's more of a political narrative than it is a reality. A data center should actually help the power situation, but all these utilities keep rising double digits on people, and I think it's pretty clear that the demand for power is pretty strong. Now, let me ask you one thing follow up, Bob, and I don't know if you have an opinion on this, but I had a conversation yesterday, and I was looking at an old deck from a couple years ago about the space data centers, right? And there's no, you laugh, but like my buddy who's the power trader I was talking about before was saying very seriously that if this takes off and SpaceX can get these things up there, that everybody's outlook for power demand in the U.S. will go away by 2030. He said this story won't play out if they go that route. So I know it sounds ridiculous, but
no.
like
Gavin Baker was on with Patrick O'Shaughnessy's podcast and talked about this at length. And obviously, Elon is a huge proponent of this. So I'm just chuckling because I just listened to it the other day, and to have it, as usual, you scan the globe for the constant variety of investing. So it's intriguing to me. I
yeah,
don't
I mean.
reject it on the other hand.
No, it just, I guess it's one of those things just to keep an eye on. Because I go back to one thing that I went back and I was reading a lot of the old PGM reports from 1999 and 2000, 2001,
You need a
because back
hobby.
then there was, what?
You need a hobby.
This is his hobby.
I kid because I love. Sorry, go ahead.
Um, well played, Bakes. Um, the no, but it was because sometimes what's really it's very useful to go back and gain historical perspective by seeing what people were saying back in time, right? Because all humans have this revisionist history where they're like, well, I saw the great financial crisis coming. It was obviously a bubble, or and it's like, well, did you act like that? Did you behave like it? But my point is that there was big power demand expectations in the build up of the internet and the build out of the fiber.
Yeah.
And so, if you go back to the .com, the big stocks, the big pure play was the infrastructure, which is again where it is here, right? And most of the people I know still think like ultimately the value will accrue to the application level. So this like the what we're talking about with you starting to talk about credit default swaps is that back then the telecoms built out the internet, right? And a lot of them went bankrupt. And like the darling of all of them, Cisco, uh, just got back to the
Yep.
price it
Yep.
was in 2000 March, right? When it was the biggest company in the world briefly. And so, the Microsoft, Google, Meta, all these guys, they built their business on the back of a bunch of bankrupt telecoms, right? Like, so now these guys are the telecoms in some senses. And so that is, I think, what's going on. The market's grappling with, which is that there's some of this re-rating is going on, is because their capex, the capital intensity is increasing, and there is a pretty large uncertainty right now about the return on the capital. And
Right.
if you fund it with your own free cash flow, the market might give you a pass because they're like, okay, it's growth, whatever. But you start funding it with debt, market's going to take it a little differently. You know what I mean? Like, there's
Yep.
guys, because look no farther than the last Meta earnings call. Meta had a pretty good top line number,
Yeah.
like, and they actually took some share in ads, but the market, the equity hold, there was definitely big active management guys who said, we do not have an interest in you spending our money, and they sold that thing. I mean, it was red candles from the day they reported for a month. It was like it was just down, down,
Yep.
down, and that's what you see when you see a big guys getting out of their position, where they just sit on the stock until they're out of there. I mean, my old shop, that's how we would trade out of things, which was a big Boston-based mutual fund. So,
This shall remain nameless.
well, there's a couple. There's a couple.
Yeah, there is. There are.
Anyway, all right, Kevin, what else you got for us today?
Yeah, before I get into this, just real quick on uranium. I am more bullish by far on uranium, the metal, and the miners than I am the nuclear plays and the SMRs, and I'm positioned accordingly. And the distinction that I make is that I think people are very U.S. understandably so. But there's enough demand from China and India alone to get uranium prices much higher. Even Japan is reopening some of their plants, and that's the genesis of this bull case back in 11, the Fukushima story, and we're just seeing it in price. Yeah, uranium is at 78.40 right now, off of the 50s. I think you take out 84, and then you really get a good chance of taking a stab at the 106 level and then the 130 all-time high. So I think it's about the most inevitable uh, 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 trend that I see. If there's an accident that's really meaningful, then all bets are off. But I'm more uranium bull than a nuclear bull. So there we go.
Okay.
All right. Platinum. Platinum has joined silver into new highs, and I forget where I bought this. I'm up like 40-50%. I forget the exact date. But what I'm doing here is that when I buy, I own the 10 best ETFs, in my opinion, out of literally 5,286. They added 100 last month again. And I'm not going to be greedy. And so every time it gets to 12, 13, 14%, I'm letting some go and cutting it back down to 10, and I just did that yesterday. Interestingly, platinum hit new highs, silver hit new highs, gold hasn't, unless it's happened while I've been on the show and I haven't been looking at the gold price on my screen. But you had a little bit of a divergence there, and gold looks like it's threatening to take out the high, and then I think you have another leg to the upside for all the precious metals, which is interesting. While Bitcoin flounders at 87,000, down from 124. So um, this is a trade that's working. I'm going to let it continue to work. It is clearly one of the 10 best ETFs out there, and I'm letting it ride but I'm not going to be dumb and not do anything while and have it become an inordinate percentage of the portfolio. So I'm letting some
All right.
go. They all kind of look like this, but MSOS, I'm here. I've got 4%, and as soon as Trump gets his pen out, I think this is going to be another rocket ship. Now, Lucy has pulled the football away many times. I'm not naive, and so I'll shoot this thing if the football gets pulled again. Again, it's a 4% position, and okay, yeah, it's up a lot, what have you, but look at the historical context. When you go from Schedule 3 to Schedule 1, I think this is going to be pretty significant. We've already taken out that trend line, and again, we just look for confirmation, and you've got a whole bunch of people that just start putting money here, and the income statements of the companies start to rip, and you've got all kinds of people at nameless Boston mutual funds that start to put a percentage of their portfolios in this. So
Do they
I'm
though? I mean, I hear you because like nobody owns anything, so there is that like step from like, hey, you got to own a little bit. So, but these aren't good businesses though. That's the thing. Like the cannabis, like you don't see like it's just a commodity, right? Like it's not like you don't see a lot of corn providers or wine companies or anything like that. I don't know. I look at this as a business that has like very challenged. But to your point, it is a business and it's not actually able to run like a business. Like they can't,
right.
they got to do cash. They can't get bank accounts. They can't do like, there's all kinds of stuff. So I agree that you go from
Yeah.
being a pariah like status business to just a business. There is some kind of jump, and then there should be some money allocated to it. But I wonder like what is fair value or what like going beneath the surface and looking at numbers. I don't know. Is it really like this huge growth industry? I do know that people aren't drinking. Came out more data came out. The people are drinking the least they ever have, basically.
Yeah, you can see it in Diageo, as the poster child. So, um, and I might go back and do this. So what happened after Prohibition, and what kind of liquor stocks emerged or showed up, or did they stop making medicine and go into booze again? I don't know. I might do that just to have some fun, because I need a hobby too, apparently, Ben. So, but I think this is going to work, and it just makes sense to me. Having a Schedule 1 is ridiculous. Am I getting that right? Yeah, Schedule 1, and it goes down to 3. I think that's right. But there we go. I got one more. You got time?
Yep.
Yeah, sure. Go ahead.
I can't believe I'm doing this, but Tesla wants to take out this 488.54 high, and I mean, it has been overvalued at 100 and 200 and 300 and 400 and 473.50. But I mean, people believe, and the shorts are, it's down to 2% of the float, 1% of the outstanding. No, 1 day to cover, and I think maybe 2% of the float. So the shorts, understandably, have gone by the wayside, but it's just incredible. Dan Ives, I'm going to listen to some podcasts with him. He's apparently, as bulled up as he's ever been on this name. But it's been an incredible story, and I can't own individual stocks. If I could, I don't have the guts to do this. I'll be honest with you. The PE is bananas, and I'm also struck by the fact that Tesla's up, Rivian's up, it was, and Ford getting out of EVs acted pretty well. So it's interesting times, but the Tesla has been the consternation of value players everywhere, and it still looks like it wants to go higher. At 488, I
Didn't
think it
they?
goes
Did they
north.
say SpaceX? Isn't SpaceX like what was the deal with SpaceX? They were buying some stock or something.
I
Somebody was.
don't. Yeah, I don't. I forget the
I have to check
transaction,
that.
but
I
there
saw
is.
some headline that was goofy, but Tesla's the craziest stock there is, honestly. Like,
Oh,
I mean, like
it's
it it
incredible.
it it fundamentally makes no sense here. You know, they come out in Europe and they say, "Hey, we're pushing back the ICE component." Like, so everyone's pushing back against the EVs. There was a guy yesterday who came out. I don't remember which car maker it was, and said, "Hey,
Ford,
you know, people just aren't buying these $50,000 to $70,000
Ford,
cars." And yeah, it's Ford. Okay, thank you. And
$19.5 billion hit.
yeah, and so, you know, what they're going to go into is more and more hybrids, which was my thesis, you know, a year ago when we first started in Wall Street. There was a stock that was a spin-off of Borg Warner, and they were direct pure play buy on the hybrid story. And it seems, you know, we have a hybrid here in LA, which is great because, you know, gas is expensive out here because of the refinery, lack of refiners. So a lot of people get EVs, but you know, it's still kind of a pain in the butt. So like, I think hybrids are just, they're pretty nice. You don't fill up your tank that much, and you know, you get kind of the best of both worlds, to be honest. But like Tesla, I don't know. Like, what robots is that? That's the new story now. Like, I mean, I struggle with this thing. Like, but I do agree with you that the chart does look good. Like, that is an objective statement.
Yeah, you know, I just I don't know. I bring it up as a a cautionary tale. How many people, this is the most absurdly valued stock. It's worth more than all the other combined ICE car companies. And I go, okay, but it's still 477, and it's ripped the shorts faces off for 400 points. And look at this is Toyota. Toyota, I think, is the king of all hybrids. I think they're wonderful cars. That's hitting new highs. So I don't know.
No. Yeah, I mean, who knows? All I know is that Tesla is its own entity that, you know, is unexplainable by logic and reason. You know,
Oh, the
so
other thing was they have they've freed the Austin robo taxis. You no longer have to have a person waiting to grab the wheel. That was they say they've got the safety and technology to the point where they can have driverless cars. So I
all
think that
right.
was part
Well,
of it
maybe that's
too.
it. Maybe that's what it is. All right. Anything else, Bob? Or else let's get out of here. Let's
Yep.
call it a day. No. All right. Cool. Yeah, we'll keep it tight. So, right in the button. Third. Benjamin Bride. That's Bob Morris. Kevin Fakes Baker. This is Wall Street Beats. We will be back this week. Come check us out at wallstreetbeats.com and have a nice day. See you guys.
Thank you.
Bye,
Thank you,
guys.
Jen.
Later. Bye.
Appreciate it.